Imagine this. You wake up in the morning, open your charts, and stare at the candles. Price is moving, but you don't know if today is going to be bullish or bearish. You draw a few lines, maybe a trend line, maybe some support and resistance, but nothing feels certain. You hesitate. Should you buy? Should you sell? And by the time you make up your mind, the market has already made its move without you. You close your laptop frustrated, whispering to yourself, if only I knew the direction before the day even started. I could have traded with confidence. I've been there. I know exactly how that feels. In my early trading days, I would wake up and guess. Sometimes I guessed right, but most of the time I guessed wrong. And when I was wrong, I wasn't just losing trades. I was losing confidence. That's when I realized something. The traders who win consistently don't wake up guessing. They wake up with a bias. They already know which direction they want to trade before the day begins. And that's what I'm going to share with you in this video. How to find your daily bias step by step. Not random guessing. Not gut feeling. A repeatable process you can use every morning to understand whether you should focus on longs, shorts, or stay out completely. Let me tell you the story of the first time I applied this. It was on EUR/USD. I woke up, pulled up the daily chart, and noticed something I had ignored before. The previous day had closed bearish, breaking a key low. On the 4-hour chart, price was pulling back into that broken level. For the first time, instead of guessing, I told myself, today my bias is bearish. I waited, entered short when price rejected that level, and watched as the market dropped straight to my target. That trade wasn't luck. It was clarity. It was the power of daily bias. So how do you build it? The first step is to zoom out. Most traders make the mistake of starting on the small time frames. The 5-minute, the 1-minute, even the tick charts. That's like trying to navigate a city with your eyes glued to the sidewalk. You'll miss the big picture. You need to zoom out first. Look at the daily chart. Look at the 4-hour. Ask yourself, is the market making higher highs and higher lows, or lower highs and lower lows? Is momentum pushing up or pushing down? That's your first clue. The second step is to identify yesterday's high and low. Why? Because the market loves to react to these levels. If today's price is staying above yesterday's high, bias leans bullish. If it's rejecting yesterday's high and trading lower, bias leans bearish. These levels act like magnets, pulling price toward liquidity. The third step is structure. Has the market broken a significant high or low recently? If it broke higher, bias shifts bullish. If it broke lower, bias shifts bearish. Simple, but powerful. Now let me pause and make this real with a story. A trader in my Discord, named Sophia, used to flip-flop every day. One morning she'd be bullish. The next she'd change her mind to bearish. And by the end of the week she was confused and exhausted. I showed her this process. Zoom out. Mark yesterday's high and low. Check the structure. The very next week she came back and said, I finally get it. I don't need to guess anymore. My bias is clear before the London Open. That week she caught 2 clean trades, both in the direction of her bias. And for the first time, she felt in control, and that's what daily bias gives you. Control. You stop chasing random setups. You stop flipping from long to short in the same session. You focus. You align yourself with the flow of the market instead of fighting it. But here's the key. Bias doesn't mean prediction. It doesn't mean you know exactly what the market will do. It means you have a plan. If your bias is bearish, you're looking for sell setups. If it's bullish, you're looking for buys. If it's unclear, you wait. That simple shift transforms your trading in the next chapter. I'll go deeper into the mechanics. I'll walk you step by step through my exact routine every morning. How I start on the higher time frames. How I refine on the 4-hour and 1-hour. And how I drop down to the smaller charts with my bias already locked in. By the time you're done, you'll have a framework you can use every single day to trade with confidence. Picture this. The sun is just coming up. You sit down at your desk with a cup of coffee, ready to trade. Most people in this moment feel overwhelmed. They open their platform and immediately dive into the 5-minute chart. Red candles, green candles, volatility everywhere. Their heart starts racing before they've even placed a trade. They feel like they have to catch something. But the truth is they're blind. They don't know the bigger picture. The traders who win, the ones who stay consistent, do the opposite. They slow down. They build their daily bias first, step by step. And that's what I want to teach you now. The exact morning routine I use to find my bias every single day. Step 1. Start with the daily chart. This is where the big story is written. Look at yesterday's candle. Was it bullish, bearish? Did it close strong or weak? Did it break a key level? If yesterday closed bearish and broke below support, today's bias is likely bearish until proven otherwise. If it closed bullish above resistance, bias leans bullish. The daily chart gives you the headline of the story before you get lost in the details. Step 2. Mark yesterday's high and low. These are critical. Why? Because liquidity sits above and below these levels. The market loves to sweep them. If today's price trades above yesterday's high and holds, you're likely looking at a bullish day. If it rejects yesterday's high and falls back, bearish pressure builds. Same with the low. Think of these as magnets, where price is drawn before deciding its real direction. Step 3. Drop to the 4-hour chart. This is where the story sharpens. The 4-hour shows you structure in more detail. Has the market been trending? Has it been ranging? Did it just break a significant level? If the 4-hour shows a series of lower highs and lower lows, bias is bearish until something shifts. If it shows higher highs and higher lows, bias leans bullish. The 4-hour is where you align with the midterm flow of the market. Step 4. Refine on the 1-hour chart. This is where you prepare to hunt. If the daily and 4-hour say bearish, you want to see the 1-hour align. Maybe rejecting resistance, maybe forming a lower high. If everything points in the same direction, that's a high probability bias. If the 1-hour is messy, step back and wait. No need to force a trade when the time frames don't agree. Step 5. Only then drop to the lower time frames. The 15-minute, the 5-minute, this is where you execute. But here's the difference. By now, you already know your bias. You're not flipping back and forth. You're not guessing. You're simply waiting for the market to give you an entry in the direction you've already chosen. Let me give you a story to make this real. A trader in my Discord named Ryan used to start every morning on the 5-minute chart. He'd see a green candle and buy, then a red candle and sell. Within an hour, he was drained and usually in the red. When I showed him this routine, daily, 4-hour, 1-hour, then lower time frames, he resisted at first. He thought it was too slow. But when he tried it, something clicked. The first morning he applied it, he marked a bearish daily close, saw a clean lower high on the 4-hour, and waited for a short setup on the 1-hour. The trade melted down exactly as planned. That day, he didn't just make money. He made sense of the market for the first time. This routine gives you clarity. It keeps you from reacting to noise. It forces you to align with the bigger picture before you execute. Here's the beauty. Once you do this enough times, it becomes instinct. You'll sit down in the morning, glance at the daily and 4-hour, and know instantly which direction you're hunting. That calm clarity is what separates amateurs from professionals. And remember, you don't have to figure this out alone. In my Discord, we go through this routine together every day. Traders post their daily bias, mark their highs and lows, and share their reasoning. It's like looking over the shoulder of a professional team before you trade. That kind of environment can accelerate your learning faster than anything else. In the next chapter, I'll take you even deeper. We'll talk about how to confirm your bias with liquidity and institutional footprints, the subtle clues left behind when smart money positions for the day. Because price action tells a story, but liquidity reveals the secret intentions behind it. Think about this. Every single day, millions of retail traders place stop losses in the same places. Just above yesterday's high, just below yesterday's low, right behind obvious support and resistance. These stop losses are orders, and where there are orders, there is liquidity. Institutions know this. They hunt this liquidity because they need it to fill their massive positions. And if you learn to spot where they're hunting, you can align your bias with theirs. Here's the key insight. Liquidity runs often come before the real move. Price sweeps one side of the market, grabs the liquidity, and then moves in the opposite direction. This pattern is everywhere once you learn to see it. Let me give you an example. Imagine yesterday's high on EAR USD is marked at 1.0750. This morning, price pushes just above that level, triggering retail breakout buys and stops on shorts. That's the liquidity grab. Then, instead of continuing up, the market rejects and drops hard. That rejection confirms a bearish bias for the day. Institutions just collected the liquidity they needed to sell, and the true direction is now down. This is why bias isn't just about candles or trends. It's about understanding the game being played behind the scenes. I remember the first time I truly understood this. I was watching GBP USD. The daily chart looked bullish, but I wasn't sure. Then, during London session, price spiked below yesterday's low, taking out liquidity, and immediately reversed upward. That single move confirmed the bias, bullish. It wasn't random. It was smart money sweeping liquidity before pushing the real direction. That trade was one of my cleanest wins that month, and it all came from reading the footprints of institutions. So how do you apply this step by step? First, always mark liquidity zones. Yesterday's high and low are essential. Add to that any obvious swing highs or lows on the 4-hour and 1-hour charts. These are the places retail traders are hiding their stops. Second, watch how price reacts when it approaches these levels. A clean break and continuation suggest the level was simply in the way, but a sweep, a quick move through the level followed by rejection, often signals the start of the real direction. Third, align this with your higher time frame bias. If the daily and 4-hour suggest bearish momentum, and you see liquidity swept above yesterday's high before rejection, that's strong confirmation of a bearish day. If the higher time frame looks bullish, and liquidity is grabbed below yesterday's low before a bounce, bias shifts bullish. Let me give you a story from one of the traders in my Discord. His name's Leo. He used to treat every breakout as a signal. Price breaks above resistance, he buys. Price breaks below support, he sells. He got trapped again and again. When he learned to think in terms of liquidity instead, his entire perspective flipped. One morning on NAS 100, he marked yesterday's high, watched the liquidity sweep above it, and instead of buying like he used to, he waited. When price rejected hard and shifted structure downward, he sold. That trade paid him 5 times his risk in under 2 hours. It wasn't luck. It was liquidity. This is why institutions always seem to know where price is going. They're not predicting, they're creating the conditions they need. They push price into liquidity, fill their orders, and then move it where they want. When you understand this, you stop trading like prey and start trading like a hunter. Now let's bring this back to bias. Daily bias isn't about guessing whether the market will be bullish or bearish. It's about building a case. Step 1. Higher time frame structure. Step 2. Yesterday's high and low. Step 3. Liquidity confirmation. If all 3 point in the same direction, your bias is clear, and your confidence grows in the next chapter. I'll take you through refining intraday execution with bias. Because knowing the bias is one thing, but trading it in real time, on the 15-minute and 5-minute charts, is where traders often lose discipline. I'll show you how to stick to your bias without forcing trades, and how to time your entries so you're moving with the flow, not against it. Imagine this. You've done the work in the morning. You've zoomed out on the daily, marked yesterday's high and low, checked the 4-hour structure, and confirmed with liquidity. You've built your case, and your bias is clear. Let's say today your bias is bearish. Now the real question is, how do you trade that bias during the day? This is where most traders fall apart. They do the analysis, but once they drop to the 15-minute or 5-minute chart, the noise takes over. Every green candle makes them doubt. Every spike makes them question everything, and before they know it, they're trading against their own bias. That's how confidence evaporates. The key is simple. Bias is your compass. Once you've set it, you only hunt in that direction. If your bias is bearish, you ignore buy setups. If your bias is bullish, You ignore sells. That doesn't mean every signal in your direction is valid, but it means you filter the market through your bias. You're no longer chasing every move. You're waiting for your move. Here's the step-by-step process. Step 1. Drop to the 1 hour and 15 minute. These are your execution time frames. Let's say your bias is bearish. On the 1 hour, you're looking for lower highs forming. On the 15 minute, you're waiting for price to rally into resistance, reject, and show signs of turning down. That's alignment with your bias. Step 2. Mark your intraday levels. These are usually supply and demand zones, intraday highs and lows, or order blocks where institutions may re-enter. With a bearish bias, you're marking levels above current price where you expect sellers to step in. With a bullish bias, you're marking levels below price where buyers may take control. Step 3. Wait for confirmation. This is where patience pays off. Don't jump in just because price touches a level. Wait for a reaction, a rejection wick, a shift in structure, a momentum candle in your direction. This is your trigger to enter in line with your bias. Step 4. Manage your trade with logic, not emotion. Your stop goes just beyond the intraday level you're trading. Your target goes to the next liquidity pool. Yesterday's low for bearish bias, yesterday's high for bullish, or the nearest swing level. That way, every trade is framed within the bigger picture you already built in the morning. Let me tell you a story to make this clear. A trader in my Discord named James used to flip-flop all day. He'd start bullish in the morning, see a red candle on the 5 minute, and suddenly go short. Then, 10 minutes later, a green candle would appear, and he'd switch back to long. By the end of the session, he had 5 losing trades and no confidence. When he learned to lock his bias in the morning and filter his intraday trades through it, his results changed instantly. One London session, his bias was bearish on GBP USD. Instead of chasing, he waited for the pair to pull back into a 1 hour supply zone. On the 15 minute, he saw rejection and entered short. That one trade melted down for a 1.4 risk-to-reward win. More importantly, it restored his discipline. This is what intraday execution looks like when you have bias. You're not reacting. You're following a script now. Here's something important. Having bias doesn't mean forcing trades. Some days, even with a clear bias, the market won't give you a clean entry. That's okay. Your job isn't to trade every day. Your job is to trade when the setup aligns with your bias. Skipping a messy day is discipline, not weakness. Another story. A trader named Mia used to take trades just because she felt bored waiting. She had the right bias but would enter too early before the setup confirmed. When she learned to simply wait, to let the market come to her, she found that her win rate jumped. She realized that sometimes the best trade is no trade. Bias isn't about prediction. It's about preparation. It's about saying, if the market moves into my zone and reacts in my direction, I'll take the trade. If it doesn't, I do nothing. That clarity is what turns bias into profit. And remember, this gets easier with support. In my Discord, we share intraday execution in real time. Traders post their bias in the morning, then wait together for setups. If nothing comes, we skip. If the setup appears, we enter with confidence. Having a community keeps you from forcing trades when the bias isn't lining up. In the next and final chapter, I'll show you how to put everything into one complete routine. From the moment you wake up, to building bias, to confirming with liquidity, to executing intraday. A full blueprint you can repeat every single day until it becomes second nature. Picture this. It's a brand new trading day. You wake up, open your charts, and instead of feeling lost or overwhelmed, you feel calm. You know exactly what to do. You're not guessing. You're not chasing. You're following a step-by-step process that gives you clarity before the first candle of the session even forms. That's the power of a daily bias routine. Let's walk through it, from start to finish. The first step is zooming out on the daily chart. This is your foundation. Look at yesterday's candle. Did it close bullish or bearish? Did it break a key level? If yesterday closed bearish below support, your initial lean is bearish. If it closed bullish above resistance, your lean is bullish. This gives you the headline for today's story. The second step is marking yesterday's high and low. These levels are magnets. The market loves to test them, sweep them, and react from them. By marking them, you already know the two battlegrounds where price is most likely to reveal its hand. The third step is dropping to the 4-hour chart. This sharpens your picture. Is the structure making higher highs and higher lows, or lower highs and lower lows? If it matches your daily lean, that's extra confirmation. If it's messy, stay cautious. The fourth step is checking liquidity. Ask yourself, where are retail traders hiding their stops? Above yesterday's high? Below yesterday's low? At obvious swing points? Watch how price reacts around these areas. A sweep followed by rejection often marks the true direction of the day. This is where institutions leave their footprints. The fifth step is refining bias on the 1 hour. Here, you're looking for clean setups in your direction. If your bias is bearish, you want to see a lower high forming. If bullish, a higher low. This sets the stage for execution. The sixth step is dropping down to intraday timeframes, the 15-minute and 5-minute. Now you're hunting for entries, but only in the direction of your bias. You wait for price to enter your zone, show rejection, and give you the green light. No guessing, no flipping, just executing the plan. This is the daily bias routine. And when you follow it, your trading transforms. Let me give you a story of what this looks like in real life. A trader in my Discord, named Ethan, used to struggle with overtrading. He'd wake up, jump straight into the 5-minute chart, and take trades in every direction. Some wins, but mostly losses. I introduced him to this routine. The very next week, he changed everything. He started with the daily chart, marked his highs and lows, checked the 4-hour, then waited for liquidity sweeps. That Friday, he shorted NAS 100 after a false breakout above yesterday's high. He entered on the 15-minute rejection and rode the trade all the way down for a 1.6 risk to reward. He messaged me later and said, "This is the first time trading actually made sense to me." And that's the difference. When you have a routine, trading stops being chaos. It becomes structured, repeatable, profitable. But here's the final piece: discipline. This routine only works if you follow it every day. Skip steps and you fall back into confusion. Cut corners and you start guessing again. But follow it with patience, and it becomes second nature. Over time, you'll glance at the charts in the morning and instantly know your bias without overthinking. That's when you know you've leveled up, and remember, you don't have to do this alone. In my Discord, we follow this routine together daily. We post our charts, mark our highs and lows, share our bias, and confirm with each other before taking trades. Having that community keeps you disciplined, accountable, and confident. So here's the big takeaway. Daily bias is not prediction. It's preparation. It's building a case so you can trade with clarity instead of fear. The market doesn't owe you anything, but when you align with its flow, it rewards patience and discipline. One setup, one bias, one routine, repeated every day until it becomes who you are as a trader. That's the path to consistency. That's how you stop being the trader who guesses and start being the trader who knows.